Good morning and welcome to the Post-Monetary Policy Committee press briefing. As is usual, we hold this after the Monetary Policy Committee meetings, and in this case, that meeting was held yesterday, the 8th of April 2025. So today, the chairman of the Monetary Policy Committee, who's also the governor of the central bank, will be taking us through the thinking of the MPC, some of the decisions made by the MPC, and some other data and statistics that inform that decision. As usual, we'll be able to take your questions and interventions after the governor has spoken. And so if you want to do that, please do so on Slido. That's www.slido.com. Please send your questions there. And this, we wish to remind you, please ensure that you include your name and institution as you ask your question. And the code is MPC 0425. So Slido.com, MPC 0425. As you ask your question, ensure that you have your name and institution within that question. But for now, I'd like to welcome and introduce the governor of the central bank, who's also chairman of the Monetary Policy Committee, Dr. Kamau Thugge.
Good morning. The Monetary Policy Committee met yesterday and decided to lower the central bank rate by 75 basis points to 10% from 10.75%. To enhance the effectiveness of monetary policy implementation framework, the MPC approved the narrowing of the width of the interest rate corridor around the CBR from the current plus or minus 150 basis points to plus or minus 75 basis points. The adjustment of the applicable interest rate on the discount window from the current 300 basis points above the CBR to 75 basis points, which will be the upper bound of the interest rate corridor. The committee noted that overall inflation was expected to remain below the midpoint of the 5 plus or minus 2.5% target range in the near term, and this will be supported by a low core inflation, lower food inflation, stable energy prices inflation, and the continued stability of the exchange rate. The committee also noted that central banks in the major economies have continued to lower their rates, but at different paces depending on inflation and growth expectations. The average lending rates have been declining gradually since December 2024, and before that around November of 2024, but private sector credit growth remains subdued. Finally, the committee noted that there was scope for a further easing of monetary policy stance to stimulate lending by banks to the private sector and support economic activity, while at the same time ensuring the exchange rate remains stable. The narrowing of the interest rate corridor in the monetary policy implementation framework will enhance stability of the interbank rate and will align the rate closer to the central bank rate. Setting the interest rate on the Central Bank of Kenya discount window at the upper bound of the corridor will ensure that the interbank interest rates remain within a predictable range. The MPC will closely monitor the impact of these policy measures, as well as the developments in the global and domestic economy, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in June of 2025. The committee considered global economic developments and outlook. With regard to inflation rates in the major economies have declined partly on account of lower energy prices, but core inflation rates have remained sticky, reflecting persistent services price inflation. Food inflation has also increased. With regard to commodity prices, the international oil prices have moderated due to increased production and subdued demand. but the risk of potential volatility remains elevated. We also expect further decline in oil prices. Production is expected to pick up by both the OPEC plus and also the non-OPEC plus producers. And of course, the muted demand and possibly the slowdown in global growth will also contribute to additional pressures to reduce the oil prices. With regard to food prices, global food inflation eased slightly in March of 2025, and this was driven by lower sugar and cereals prices inflation, but edible oil prices inflation remains elevated. Global inflation has moderated, supported by lower energy prices, but the outlook is uncertain due to the potential inflationary impact of the higher tariffs on imports. The chart that we have there is from the previous estimates by the IMF on the World Economic Outlook that was published in October of last year, and did show that global inflation would decline from 5.7% to 4.2% this year, and further to 3.5% next year. Of course, with the higher tariffs, we expect these inflation rates not to decline as much, but we await the next World Economic Outlook by the IMF, which should come out later this month. So the headroom for further reductions in interest rates in the major economies may be affected by the inflationary impact of higher tariffs. With regard to the global economic outlook in terms of growth, the 2025 growth is highly uncertain, with elevated risks of a potential slowdown following the escalation of trade tensions attributed to the new tariffs on all U.S. imports and the retaliatory tariffs by trading partners. Before the increase in tariffs, the global growth was expected to slow down from 3.2% in 2024 to 3.1% and further to 3%. And mainly the slowdown in 2025 and 2026 was as a result of lower growth in the Eurozone area, lower growth in the United Kingdom and also in the United States, but also the lower projected growth of India in both 2025 and in 2026. Again, we will get a better idea of the expected global growth in the forthcoming WEO economic outlook that is expected later on this month. Global financial conditions have been very volatile and reflected in declines in the equity indices and increases in bond yields. And this is amid concerns of higher inflation and the potential slowdown in the global economic growth due to the higher tariffs on imports. And of course, these developments are likely to have implications for access to international capital markets by emerging and developing market economies, which also includes the Kenya. To summarize on the global developments and outlook, the global headline inflation has moderated, but the outlook is uncertain due to expectations of a potential inflationary impact of the higher tariffs on U.S. imports and the potential retaliation by the trading partners. The central banks in major economies have continued to lower their interest rates. The global growth was on a steady recovery in 2024, But the outlook for 2025 is highly uncertain due to the escalation of trade tensions. The global financial conditions are volatile, reflecting again the elevated concerns on tariffs, and the risks to the global growth as well as inflation are elevated, again reflecting all these tensions as well as the continuing geopolitical risks. Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa and emerging market and developing economies averages both in 2025 and in 2026. Turning to the domestic macroeconomic developments and outlook, overall inflation remained below the midpoint of the target range of 5 plus or minus 2.5% in March 2025, supported by a decline in non-core inflation. Inflation in March increased to 3.6 from 3.5 in February, and this increase was because of an increase in core inflation from 1.9% to 2.2%. On the other hand, the non-core inflation declined from 7.7% to 7.4%. In terms of contribution to overall inflation, the non-core inflation contributed 2.2 percentage points, whereas the non-core inflation contributed to 1.4%, and the sum of the two is a 3.6% of overall inflation in March 2025. And again, just to remind, the core inflation comprises of 81.1% of the overall CPI, and the non-core inflation only comprises of 18.9%. The core inflation remained low in March 2025, as I said, at still at 2.2%. And really, as you can see from that chart, the core inflation since about July of 2024 has been around 2.2%. It sometimes has gone to 1.8 as it did in October of 2024. But generally, it has stabilized around the 2.2% area. The increase in March from 1.9 to 2.2 was mainly because of processed food items, whose contribution rose from 0.1 to 0.4, and that can be seen at the very bottom of that column at the end. Non-core inflation declined, as I said, in March 2025, and this was supported by declines in inflation for food crops and related items and energy prices. And going forward, we do expect the already international oil prices have reached around $61 per barrel. And therefore, going forward, we expect the contribution of energy, fuel, and utilities inflation to even be more negative than the minus 1.6. And of course, with the good weather, we also expect the food crops and related items inflation to decelerate from the 8.2% that is shown there. In terms of inflationary expectations, the March 2025 agricultural sector survey and also the CBK projections show that inflation expectations remain anchored with a target range in the near term. In terms of the inflation expectations in the next 3 months, the survey indicated that 53% of the respondents actually expect a decline or inflation to remain unchanged, and only 47% expect an increase in the overall inflation within the next 3 months. So to summarize on developments, overall inflation at 3.6% in March of 2025 remains well below the midpoint of 5%. Going forward, it's expected to remain below the midpoint of the 5% midpoint, and this will be supported by low core inflation, will be also supported by low food inflation, low energy prices, and a stable exchange rate, which is expected to continue to moderate prices. The main risk to the inflation outlook relates to a potential inflationary impact of the tariffs on all U.S. imports, and of course the continued geopolitical conflicts in the Middle East and between Russia and Ukraine. Turning to the domestic economic growth, the economy is projected to pick up in 2025 and in 2026, supported by resilience of key service sectors and agriculture. Expected recovery in growth of credit to the private sector, and also because of improved exports. In regard to agriculture, we projected growth of 5% in 2024, slightly below the growth in 2023 of 6.5%. And going forward in 2025 and also in 2026, we expect agricultural growth to average about 5%. In regard to the industrial sector, performance in 2024 was very unfavorable. The growth was only 0.4% and reflected the contraction in the mining and quarrying sector, which we have estimated at minus 9.1%, and also the construction sector, which also we have estimated to have contracted by minus 1.1% in 2024. Going forward, however, we expect a recovery, especially in the construction sector, which we have projected to increase by 4.7% in 2025 and a further 5.5% in 2026. And this growth is supported by the fact that now the ministry, the roads ministry, is clearing the pending bills to the contractors and has already started to pay the contractors, and we expect the roads construction work to start and to accelerate. The services sector has contracted in 2024 to 5.8% from previously 7%. But now with the interest rates coming down, we do see a recovery, modest recovery to 6.3% in this year and to 6.4% next year. This is still below the average that we experienced in 2021 and 2022 of 7%. So putting all those together, the growth for 2024 is estimated at 4.6%, a recovery to 5.4% this year, and a further increase in growth to 5.6% next year. So sectoral growth credit to the private sector has improved in March 2025. And you can see for example, in the manufacturing sector, credit expansion was negative, in fact, a large negative of minus 14.3 around September of 2024. But since that time, the negative number has reduced to about minus 5.4 in March. Similarly, for the trade sector, we've seen a pickup in credit there since the beginning of this year, as well as the tourism and communication sector, and also the consumer durables sector. We have seen increased credit to that particular sector. So to summarize, the economy is estimated to have expanded by 4.6% in 2024. Down from 5.6% in 2023. Leading indicators of economic activity point to improved performance in 2025, in the first quarter of 2025. And we do project an improvement in real GDP growth to 5.4% this year and a further 5.6% in 2026. The growth outlook is subject to both external and domestic risk, including the trade tensions that I've mentioned and the geopolitical conflicts that I also mentioned earlier. Turning to monetary developments, the growth in broad money supply improved in February and March of 2025, and this reflected reduced exchange rate valuation effects attributed to the appreciation of the shilling. So growth in M2, and M2 is basically M3 minus the foreign currency denominated deposits. That has continued to pick up. But in short, the current broad money M3 growth recorded a growth of 6% in March, and this is compared to 1.3% in February, and actually a contraction in March of minus 1.4. In terms of credit to the private sector, this has recovered to record a very modest growth in March of 0.2, and this is compared to the negative growth in February of 1.3 and in January of 2.9%. The growth in foreign currency loans to private sector improved in March 2025, while growth in the local currency loans remained subdued due to the net repayments of loans. So you can see the dark line is the foreign currency denominated loans, and you can see a turnaround even beginning December 2024, and as of March 2025 we do see a growth of 2.1%, but only for the foreign currency denominated loans. The local currency loans continue to not perform as well, and the combination is the line in the middle, which shows credit to the private sector picking up only by 0.2% in March. The short-term interest rates have continued to decline and declined further in February and also March of 2025, and this was in line with reductions in the central bank rate. The 91-day Treasury bill now is at 8.9%. Towards the end of last year, it was at almost 17%, was 16.7. The 182-day Treasury bill is now at 9.1%, and A2 was near 17% at the end of last year. And finally, the 364-day T-bills are at 10.5%. The commercial bank lending rates have started to decline. And as of March, the average was 15.8% compared to 17.2% in November of 2024. And with inflation at 3.6% in March, we see that the real lending rates have declined from 14% to 11.7%. The monetary policy framework, which we introduced in August of 2023 and which we have been refining since that time, it has the enhanced stability of the interbank rate and aligned the interbank rate to the CBR since the narrowing of the corridor width from plus or minus 150 basis points in June 2024 And as you recall, previously the corridor was plus or minus 250 basis points. And of course, yesterday the Monetary Policy Committee approved for it to be reduced further to plus or minus 75 basis points. And this narrower interest rate corridor will ensure that market interest rates closely track the CBR, and which should lead to a more effective monetary policy transmission. So in summary, the growth in money supply continued to recover in March of 2025. The pickup in growth of monetary aggregates expected in the near term, and short-term interest rates, particularly the interbank rate and the treasury bill rates, have declined in line with the reductions in the CBR. The commercial banks' average lending interest rates have continued to decline, and the decline in short-term interest rate is expected to continue, transmitting into lower lending rates and improved lending to the private sector. Turning to the balance of payments developments, the Kenya National Bureau of Statistics has revised the balance of payments data to improve the recording of cross-border transactions related to imports and re-exports of petroleum products under the government-to-government contracts. The revisions also incorporate use of alternative data to improve data on international trade in services, particularly travel and financial services. The revised data incorporates adjustments of re-exports data of oil products to the region and the adjustment of international travel receipts. So the balance of payments, just looking at the first line is the current account. We see a deficit in 2024, which is the third column from the right. We see a current account deficit of 3.4 billion, and that current account deficit widens, or is expected to widen in nominal terms to minus 3.8 billion in 2025. But despite that, the financial account towards the end, you can see towards the end of the page, and 4 lines from the bottom of the page is the overall balance of payments, which takes into account the current account developments and also the financial sector developments. And you can see in 2024, we had an overall balance of payments surplus of about $1.5 billion. This is one of the largest balance of payments surpluses we've had. And that surplus, together with the IMF disbursements, which amounted to about 1.3 billion, allowed the central bank to build up its international reserves by the 2.7 billion that is shown there. It's the second line from the bottom. And by the central bank increasing their reserves by 2.7, we were able to increase our gross usable reserves from about $6.5 billion to a record high of $9.3 billion by the end of 2024. For 2025, we also expect a surplus, slightly less, of $665 million. The current account, in terms of the GDP, has stabilized at around 2.8% of GDP. That was recorded in 2024. And we also expect the current account to be minus 2.8% of GDP this year. For the 12 months to February of this year, the current account narrowed to 3.1%, and this was compared to minus 3.3% in the previous year. The exports of goods increased by 13.1% in the 12 months to February to reach $11.6 billion. And for the year as a whole, last year in 2024, we saw exports increase by 15%. We are projecting a further increase of 12.8% this year. Already for the first 2 months of this year, we see an increase in overall exports by 5%. Goods imports increased by, in 2024, increased by 10.7% compared to the 3.4% the previous year. The difference was that in 2023, most of the increase in imports was related to food items, and in 2024, in fact, the growth in imports of food was negative, and what increased was the importation of intermediate goods and also capital goods. In 2025, we expect a slightly slowdown in imports to 9%. So far this year, for the 12 months up to February, we've seen an increase in imports of 10.6%. And for the first 2 months of this year, we have seen an increase in imports of 8.6%. And again, most of this is related to intermediate imports as well as capital goods imports. In terms of the services receipts increased by about 12.1% in 2024, and we expect a further increase of 7.5% in 2025. This year, for the 12 months to February, we've seen an increase of 14%, and for the first 2 months of this year, we've seen the services exports, and here I'm referring to transport services as well as travel receipts. These have increased by 5.6% in the first 2 months of 2025 compared to the first 2 months of 2024. Tourist arrivals remained strong in 2024, increased by 14.6%, and this was on top of a fairly strong increase the previous year of 40.8%. For the 12 months to February, we've seen an increase of 8% in tourist arrivals, and for the first 2 months of this year compared to the first 2 months of last year, we've seen an increase in tourist arrivals of 13.3%. Remittances inflows have remained strong despite increased global uncertainties, supported by resilient labor markets in the United States and also government policies to export skilled labor. So for last year, 2024, we saw remittances increase by 18%, and this year we have reduced. We've been more cautious in terms of our projection, and therefore we are projecting remittances inflows to increase by 6.5%. For the 12 months to February of this year compared to last year, remittances have increased by 14.5%, and for the first 2 months of this year, we've seen a bit of a slowdown, and remittances have increased by 1.4%. On the CBK's usable foreign exchange reserves, these have now reached the highest levels at 9.9 billion, and this continue to provide adequate cover and a buffer against short-term shocks. And this 9.9 billion, they cover 4.44 months of import cover, which is consistent with our target of 4%, but still a bit short of the ESC convergence criteria of 4.5 months of import cover. The current shilling has remained stable, supported by diversified foreign exchange inflows from remittances, offshore banks, and tea, of course, tourism that I just mentioned, as well as improved confidence in the economy. The exchange rate that you are seeing there of 129.26 at the end, there has been a bit of some pressure since the tariffs started to go up. And we have seen some pressure on the shilling, which has depreciated to 129.65 as of yesterday. So the Kenyan shilling has remained stable against the US dollar, and you can see there since January 2nd to March 28th of 2025, the Kenyan shilling has actually appreciated by 0.03. Really, it just has been stable compared to some of the other major global currencies. Vis-a-vis the African currencies, again, we have that stability at 0.03. And on the one end is the Moroccan dirham, which has appreciated by 4.9%. And on the other side is the Tanzanian shilling, which has depreciated by almost 9%. So to summarize developments in the balance of payments, the current account deficit has narrowed to 3.1% in the 12 months to February, compared to 3.3% last year. And of course, for this year, we expect it to continue to narrow to 2.8%, which was the same level last year. And this will be supported and will be fully financed. This deficit will be fully financed for this year by capital inflows, and should result in a further build-up of international reserves by the central bank, amounting to 665, and this should bring the gross reserves of the central bank to about $10.8 billion by the end of 2025. The main external sector risks relate to, again, trade tensions, then geopolitical tensions, and the intensification of these geopolitical conflicts. On fiscal performance, the expected fiscal consolidation over the medium term should reduce debt vulnerabilities, while moving the debt to GDP ratio towards a stronger sustainable position. The supplementary budget that is now in Parliament is estimated to have a deficit of 5.1%, but this is still a narrowing from the deficit of 5.3% of GDP that was recorded for the fiscal year 2023 to 2024. And over the medium term, that deficit is expected to narrow to below 3% by the year 2028-2029. The banking sector remains stable and resilient. The total capital adequacy ratio stood at 21.1% in February of 2025. And this is an increase from 19.4% in December of 2024, while the liquidity ratio increased to 58.3% in February from 55.8% at the end of 2024. The capital adequacy and liquidity ratios were above the minimum statutory limits of 14.5% and 20% respectively. The gross NPLs to gross loans ratio increased to 17.2% in February of 2025 from 16.4% in December of 2024. But banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers for the stability of the banking sector. So to summarize and the key takeaways, the outlook for global inflation and growth in 2025 is uncertain, reflecting the escalation in trade tensions attributed to restrictive trade policies and the geopolitical developments and the impact on oil prices. On the domestic front, overall inflation remains anchored within the target range. The Kenya shilling has remained stable and is expected to remain so. And interest rates have continued to decline, which should boost credit to the private sector and improve growth prospects going forward. And with stability in prices and the exchange rate, the CBK has continued to support the government's economic growth objective, as reflected in the further lowering of the CBR and the continued strengthening of the monetary policy implementation framework by the MPC. Thank you very much.
Thank you very much, Governor. That was the Governor of the Central Bank of Kenya, who's also the Chairman of the Monetary Policy Committee, Dr. Kamau Thugge, taking us through the deliberations of the Monetary Policy Committee and also some of the data that was looked at and considered by the committee. So we'll go straight into your questions. And before I begin, I just want to warn you that there's quite a number, so there will be some disappointments and some questions we'll not be able to take, but we'll try as much as possible to get the flavor of what the questions are about and make sure that those questions are put in. But if you go into Slido, you'll realize by my last count there were more than 50 questions, and obviously we have limited time. So to jump straight into them, we'll begin with George Obulutsa from Reuters, who's asking about an update. So the question is, what update do you have on Kenya getting a new IMF program in terms of amounts? Will it be discussed at the spring meetings? And also, is there any update on the UAE loan?
What are you reading?
If we just give it 1 second. So just to continue with the questions that we had begun with George Obulutsa from Reuters, who's asking about an update on Kenya getting a new IMF program, and also he's asking about the amount of that program. To continue with that question, whether this new IMF program will be discussed at the spring meetings of the IMF, and also is there any update on the loan from the United Arab Emirates. Brian Goge from the Standard newspaper is asking, what impact is a Trump tariff expected to have on Kenya's economy? Also, what is the CBK's stance on the new manipulation allegations against the shilling? Kefa Moirori from the Nation Media Group, CBK conducted on-site inspections to ascertain that banks were cutting rates in line with the risk-based pricing models. What is the outcome of this probe?
Thank you. Let me start with the first question by George, which is an update on the Kenya getting a new IMF program. Of course, we are in discussions with the IMF, and we will, and indeed, we will continue these discussions during the spring meetings. Of course, the amounts are not known at this stage, but we would probably be asking for normal access rather than for exceptional access when indeed we finalize on the discussions. On the UAE loan, we're still expecting that in this financial year, and the Treasury is working on it. The second question is by Brian, the impact of the Trump tariff, and what impact is expected to have on the Kenyan economy. Yes, we have looked at the 10% increase in the tariff on our exports to the U.S. Basically, we export roughly about 600, in round numbers, $650 million, and in an extreme case, we'd expect, if that does not change, that could have an impact, the 10% could have an impact and reduce our exports to the U.S. by roughly $100 million. So in terms of it's still relatively small compared to, of course, our GDP. Our GDP is north of $122 billion, and also we don't expect that that 100 million would have any significant impact on the overall balance of payments, and therefore on the exchange rate. This issue of manipulation of the shilling exchange rate, again, just to reiterate, and I just went through the overall balance of payment surplus that we recorded last year. We've had very good performance in terms of exports. We've had good performance in terms of travel receipts, and we've had good performance in the current account. The current account has been relatively steady and stable at 2.8% of GDP, and we've also had significant capital inflows. So what is reflected in the exchange rate is really the forces of supply and demand, and all we have really tried to do is to avoid fluctuation or volatility in the exchange rate. And really, I think our strategy has worked very well. We have been able to build these external buffers by increasing our reserves, and because of that, we have seen really a stability of the exchange rate. And I think that's the way it should be. And that strengthening of the balance of payments has helped us in terms of stabilizing the exchange rate, and really at the same time being able to build up our international reserves to the highest level that we have ever had before. Kefa Morori asked about the on-site inspection of the banks. This process is still ongoing. We have so far we have done 13 banks. We expect to do all the 38 banks by the end of June. We will soon start having discussions with the boards for those where we have completed with the inspections, and then following that, decisions obviously then would be made as to what kind of penalties, if any, that will be brought on board.
All right, thank you. So the second batch begins with David Herbling from Bloomberg News. Do you see Kenya and other emerging markets being priced out of global capital markets due to yields surging? And he continues asking, with no aid and no access to Eurobonds, which way will there be to fund budgets? Julian Zamboko from NTV says CBK gave 24 banks until April the 1st to table capital raising plans. Did all 24 comply? how many are angling for consolidation as the way? Eric Mokaya from Mwango Capital, with non-performing loans rising to 17.2%, are you concerned that banks will continue favoring lending to government over extending credit to the private sector? Finally, for this batch, Stella Swake from Standard Investment Bank, CBK's recent moves suggest continued liquidity mop-up from the interbank market. Why not encourage private sector lending instead?
So, okay, let me start with David Habling. It's true that the yields on bonds have surged, and definitely this will have a significant impact on access of the capital markets by the emerging markets and developing economies. And I do see that this will be a significant problem for funding budgets. Certainly for us, so far, we and for the as far as I'm aware, in this year, in 2024-25, that should not be an issue, and the 2025-26, there is some estimates of some commercial borrowing. Of course, it's a bit too early, and we'll have to wait and see how long these yields remain elevated at these levels. But certainly, for the time being, it is a disincentive to issue bonds in the international capital markets. Julian's Amboko, yes, we gave the 24 banks up until April 1st to table their capital raising plans. So far, 22 banks have submitted their plans. The other 2 have requested for a bit more time. They are actually subsidiaries of foreign banks, so they should be able to get the necessary capital. But we are now looking at the 22 banks, and we will start to engage them on the way forward. On the NPLs rising to 17.2%, yes, it's a concern, and this is why we have been trying to encourage the banks to lower their interest rates so that you can get more people to borrow and to be able to build their businesses and be able to pay back some of their loans. And also, just from a purely technical point of view, the increase in credit just by itself should lower the ratio from the 17.2%. So I think going forward, by the fact that we have that we are encouraging the banks to lower their lending rates to stimulate credit to the private sector, that should have an impact on NPLs. In addition to that, as I said earlier, the ongoing efforts by the Ministry of Roads to deal with the pending bills, and then they have gone a bit further than the National Treasury. I think that process of getting rid of the road sector pending bills should also have an impact on the NPLs, because some of the NPLs are actually in the construction sector. I think the CBK, Stella Swake, so this central bank's recent move suggests continued liquidity mop-up from the interbank market. I think, Stella, it's important to again understand the monetary policy framework, which is that once we set the CBR rate, we then intervene in the market to ensure that the interbank rate closely follows the CBR. That is the framework that we have. And so when the interbank rate is above the CBR, we intervene and we inject liquidity. When it's below the CBR, we intervene and withdraw liquidity so that the interbank rate very closely tracks the CBR rate. And so now that we have reduced the CBR from the 10.75 to 10%, this will now be an opportunity to inject liquidity in order now to lower the interbank rate, which is hovering around 10.7, and that now will move towards the 10% of the new CBR.
Thank you. And the last batch of questions, simply because we need to take care of time. We begin with Victor Mukabi from the People Daily. So Victor asks, how have Trump's tariffs route affected Kenya, and what are the short-term and long-term strategies and possible major losses? Herald Allo from the Africa Report speaks about the government-to-government oil deal, which was supposed to stabilize the Kenya shilling. With this extension, how do you foresee the additional benefit, if any, in the exchange rate market, and should we expect a stronger Kenya shilling? Anna Nanjala Wekesa from the Kenya Times. What steps is the Central Bank of Kenya taking to maintain the stability of the Kenya shilling amid global economic uncertainties? And finally, Jimmy Mbogo from Citizen Television. How soon can commercial banks expect direction from the Central Bank of Kenya on the base for their risk-based pricing model? And also, what is the update on the number of transactions flagged by banks for those above $10,000 US?
Yeah, I think starting with Victor, and the question there is the impact of the tariffs on the economy. And as I said earlier, we have looked at this impact and what it's likely to do to our exports. And what we've, by actually lowering the CBR to 10% and trying to encourage banks to lend more, we expect, therefore, maybe even increased consumption by the private sector. We expect maybe an increase also in investments. And therefore, by doing that, we try to offset some of the negative impact of lower exports by trying to encourage aggregate demand. And so I do think that the impact of the higher tariffs on the economy will be muted by the expansion on the aggregate demand side, whether it's the private sector increase in both consumption and investment, and that should, I think, offset some of the negative impact of the tariffs on our exports. On the G2G, the question here, Harold Allo is asking about whether the G2G, whether it could result in a stronger shilling. I think the exchange rate where it is now at around 129, 130, we feel that that is all those into account, that exports seems to be doing well. As I said earlier, exports through February are increasing by over 13%, and imports also for the 12 months to February are increasing by 10.6%. So I think taking all that into account, we feel that there's no need for a stronger shilling, and there's no need for a weaker shilling. I think we're just at the right place. The Anna Wekesa of the Kenya Times, I think, has asked this similar question: what the CBK is doing to maintain the stability of the Kenyan shilling. I think I've answered that. And then finally, there's Jimmy Bogo. How soon can commercial banks expect direction from the CBK on the base for their risk-based pricing model? Let me say that we are reviewing the risk-based pricing model. We will be working with the banks. We have ourselves come up with a proposal, and we will be engaging the banks, and hopefully by the next Monetary Policy Committee meeting, we will have a revision of the risk-based pricing model.
So thank you very much. That brings us to the end of this particular post-MPC briefing. And again, my apologies if you didn't manage to get to your question. There was quite a number, but we tried making sure that as much of, or as many of the topics were covered as possible. We expect the MPC, as it announced yesterday, to meet next in June of this year, so in 2 months' time. So until then, please continue following the stuff that you're doing, and see you at that point. Thank you very much, and see you soon.